Right now, approximately $1.5 trillion in office real estate loans are coming due, and the buildings backing those loans are worth a fraction of what they were when the debt was written. That is not a forecast. That is the current position of the American commercial real estate market. The question nobody in finance wants to answer on the record is deceptively simple. When these loans mature and the borrowers can't refinance, who absorbs the catastrophic loss? Is it the banks, the pension funds managing your retirement, the insurance company backing your policy, or, through a mechanism most people never see coming, is it you? This is the story of 3 office buildings, 3 different owners, 3 different lenders, and one financial system quietly trying to make $1.5 trillion in pain disappear. In 2019, a gleaming 42-story office tower in San Francisco's financial district was appraised at roughly $300 million. The loan against it was $215 million. That's a healthy loan-to-value ratio, conservative even, the kind of underwriting that makes a bank's risk committee feel good about a Friday afternoon. Then, the pandemic happened. By 2023, that same building was being marked by distressed debt analysts at somewhere between $80 and $110 million, a valuation collapse of nearly 65%. The loan, of course, hadn't shrunk. This is not an isolated story. Across Chicago, Washington, D.C., Los Angeles, and New York, office buildings purchased and financed at the peak of the market are now sitting at vacancy rates that would have been considered catastrophic just 5 years ago. San Francisco's overall office vacancy rate crossed 30% in late 2023, a number that would have seemed fictional in 2018. Here is the structural problem that turns a real estate correction into a systemic financial event. Office buildings, unlike homes, are valued almost entirely on their income, specifically on what's called the capitalization rate, the ratio of net operating income to property value. When a building loses tenants, its income drops. When income drops, its value drops. When its value drops below the loan balance, the borrower is underwater. And in commercial real estate, when you're underwater, you don't quietly keep making payments the way a homeowner might. You hand the keys back. That process, called jingle mail in the residential world, deed in lieu in commercial, has already begun happening at scale. Brookfield defaulted on $750 million in Los Angeles office loans in early 2023. PIMCO's Columbia Property Trust surrendered 7 office towers across New York, San Francisco, and Boston rather than refinance. Blackstone restricted withdrawals from its flagship real estate fund as redemptions overwhelmed incoming capital. These are not small operators. These are among the most sophisticated real estate investors on the planet. When they walked away, it wasn't because they ran out of money. It was because the math told them the buildings were worth less than the debt. And rational actors don't throw good capital after bad. So the lenders are left holding collateral that's worth a fraction of the loan. And those lenders, the ones who now have to mark something down, renegotiate, foreclose, or extend, are where the real story begins. Let's follow the money through 3 specific buildings. Building 1 is our San Francisco Tower. The originating lender was a mid-sized regional bank, the kind with between $10 billion and $100 billion in assets. Regional banks collectively hold approximately 70% of all commercial real estate loans in the United States. 70%. When analysts began stress testing the banking system after Silicon Valley Bank's collapse in March 2023, commercial real estate exposure was the second story. The one that didn't get the headline, but scared the people who actually understood balance sheets. A Federal Reserve study published in mid-2023 identified over 300 small and mid-sized banks with CRE concentrations exceeding 300% of their capital. That means, for every dollar of equity protecting depositors, there are $3 of commercial real estate loans potentially going bad. Building 2 sits in downtown Chicago. But this loan didn't stay on a bank's books. It was packaged into a commercial mortgage-backed security, a CMBS, and sold to investors in tranches. The senior tranche went to insurance companies. The mezzanine tranche was absorbed into collateralized loan obligations. The equity tranche was held partly by pension funds reaching for yield in a low-rate environment. This is where the loss transfer mechanism becomes elegant in its brutality. CMBS. Structures were designed to create distance between the originating lender and the ultimate risk bearer. The bank that wrote the loan got paid at issuance. The credit rating agency that rated the senior tranche, AAA, collected its fee and moved on. The insurance company and pension fund, the ones who actually hold the paper today, were 2 or 3 steps removed from any due diligence on the underlying building. When Chicago office vacancy crossed 20%, and the anchor tenant in Building 2 exercised a lease termination clause nobody had stress-tested in the underwriting model, the CMBS went into special servicing. Special servicing is the commercial real estate equivalent of financial purgatory. The loan doesn't default immediately. It gets transferred to a workout specialist who tries to extend the debt, restructure terms, and keep the loss off the books as long as possible. This is the extend and pretend spiral. And it matters because extend and pretend doesn't make losses disappear. It schedules them, often concentrating them into a narrow future window. That window is now. Between 2024 and 2026, an estimated $1.5 trillion in commercial real estate loans will mature. Refinancing at current interest rates, with current valuations, is mathematically impossible for a significant share of that portfolio. Building 3 is in Washington, D.C. This one has a government angle. The loan was partially guaranteed through a program administered by a federally backed entity. When the borrower sought relief, the chain of exposure ran through a series of entirely legal and entirely opaque financial structures, directly toward instruments held by insurance companies regulated at the state level. Insurance companies collectively hold approximately $500 billion in commercial real estate debt and equity exposure. When those assets deteriorate, the downstream effect hits policyholder reserves, the money set aside to pay future claims. Regulators in several states have quietly begun requesting more frequent portfolio disclosures from insurers with elevated CRE concentrations. Quietly, not publicly. If you're still watching, you already understand why this matters beyond the headlines. The mechanism we're describing, where loss is transferred, obscured, and ultimately socialized, is the same one that preceded 2008. The details are different. The structure is uncomfortably familiar. Drop a comment telling me which institution you think absorbs the largest loss when this resolves. Banks, pensions, insurers, or taxpayers. Your answer might surprise you by the end. Here is what a resolution actually looks like, in practice, not in theory. A regional bank forecloses on Building 1 in San Francisco. The bank now owns a 42-story building it doesn't want, can't sell at loan value, and must carry on its balance sheet at marked-down prices. Under current accounting rules, a bank can delay recognizing that loss if it believes the impairment is temporary. This is not fraud. It's a judgment call that happens to benefit the institution making the judgment. But regulators eventually force a reckoning. The bank raises capital, its stock dilutes. Depositors, watching the headlines, quietly move funds to larger institutions. This is how regional banks become systemically fragile without technically failing. For the CMBS structure around Building 2, the resolution is slower and more dispersed. The senior tranche, held by the insurance company, takes a partial haircut, perhaps 15 to 20 cents on the dollar against what it paid. The mezzanine is largely wiped out. The pension fund's equity position goes to zero. That pension fund manages retirement assets for somewhere between 50,000 and 200,000 public employees, teachers, firefighters, municipal workers. The fund's board reviews its actuarial assumptions. It finds it's now underfunded. It requests increased contributions from the sponsoring municipality. The municipality either raises taxes, cuts services, or requests state assistance. The loss, which began as a vacancy problem in a San Francisco office tower, has now become a funding shortfall in a public school district somewhere in the American Midwest. And Building 3, the one with federal adjacency, when the insurance company holding the paper requests regulatory relief on its reserve calculations, state insurance commissioners have a choice. They can enforce the rules and trigger visible capital shortfalls. Or they can quietly adjust the timeline for compliance and allow the exposure to be absorbed gradually. Passing the risk forward in time rather than backward to the originator, most will choose the quiet path. This is how a $1.5 trillion problem becomes a $1.5 trillion subsidy, paid not through a single visible check, but through diluted capital ratios, underfunded pensions, softened insurance reserves, and the silent taxation of time. The three buildings in this story are real in their mechanics, if not their precise addresses. The financial structures around them are not hypothetical. The chain of exposure, from originating bank to securitization vehicle to pension fund to insurance reserve to regulatory forbearance, is how modern financial systems absorb losses too large to recognize all at once. It's not a conspiracy, it's a design feature. The question for anyone with retirement assets, bank deposits, or an insurance policy is not whether these losses will be recognized. They will be. The question is in what form you'll be asked to absorb your share. The office real estate crisis doesn't end with a visible collapse. It ends with small, quiet adjustments, lower returns, higher premiums, reduced benefits, spread across millions of people who'd never set foot in a downtown office tower. That's the mechanism worth understanding. And if you want to understand the broader pattern behind how financial risk gets socialized, watch this next. Because $1.5 trillion in office loans is only one of the time bombs. There's another one, twice the size, that almost nobody is watching. $1.7 trillion sitting inside something called private credit. A market so opaque that even regulators can't see inside it. Wall Street's next Lehman might already be here. That story is on your screen now.